In the last chapter, we studied reversals. We learned that a real reversal needs evidence. Structure has to weaken. The old direction has to fail. New structure has to begin forming. But many reversals and continuations happen near the same kinds of places. Obvious highs, obvious lows. Pullback points? This chapter gives those places a name. ICT liquidity. In this context, liquidity means places on the chart where orders may be waiting. Those orders might be stop losses. They might be breakout orders. They might be orders from traders who are reacting to a visible level. We do not need to know every order in the market. We only need a useful chart idea. Obvious levels often attract attention. Attention can create liquidity. Think about a prior high. Some traders see that high as resistance. Some short sellers may place stops above it. Some breakout buyers may place buy orders above it. Now think about a prior low. Some traders see that low as support. Some long buyers may place stops below it. Some breakout sellers may place sell orders below it. That is why highs and lows matter. ICT traders often use two simple labels. Buy-side liquidity is usually above price. It can sit above highs, equal highs, or obvious resistance. Sell-side liquidity is usually below price. It can sit below lows, equal lows, or obvious support. The names describe the side of the market where orders may be resting. They help you map the chart with cleaner language. External liquidity is usually outside the current dealing range or outside the current leg. It may sit above a major swing high. It may sit below a major swing low. External liquidity is the obvious outer target on the chart. If price is moving inside a range, the range high and range low can become external liquidity. External means outside the smaller move you're currently watching. Internal liquidity sits inside the larger move. It may form around a pullback high. It may form around a pullback low. It may form around a small cluster of candles inside a trend leg. Internal liquidity helps explain why price may pause, retrace, or rebalance before reaching a bigger target. External liquidity is the outside point. Internal liquidity is inside the path. A useful way to read price is to ask where the next pool of liquidity might be. Price may move from an internal pool to an external pool. It may take sell-side liquidity below a pullback before moving toward buy-side liquidity above a high. It may take buy-side liquidity above a small high before moving toward sell-side liquidity below a larger low. This does not predict every move. It gives you a map. Equal highs are a classic place to mark buy-side liquidity. When two highs are close together, many traders notice the level. Some see resistance. Some wait for a breakout. Some place stops just above the highs. That attention can make the area important. The lesson is not that equal highs must be swept. The lesson is that equal highs are visible. Equal lows are a classic place to mark sell-side liquidity. When two lows are close together, many traders notice the level. Some see support. Some wait for a breakdown. Some place stops just below the lows. That can make the area a liquidity pool. Again, nothing is guaranteed. The level simply becomes part of the map. A liquidity run is not the same as a clean breakout. A clean breakout moves beyond a level and holds beyond it. A liquidity run may move beyond a level, trigger orders, and then fail back inside. This is why response matters. If price runs above a high and accepts higher, that can be continuation. If price runs above a high and rejects, that may be a sweep. The move beyond the level is only the first clue. A sweep becomes more interesting when rejection appears. Price may push above a visible high, then it may close back below the level. That says the move above the high did not hold. Price may push below a visible low, then it may close back above the level. That says the move below the low did not hold. The sweep is about the failure to accept beyond the level. You may hear the phrase draw on liquidity. This means price appears to be drawn toward an obvious liquidity pool. For example, if price keeps making higher lows beneath an obvious high, that high may become the draw. If price keeps making lower highs above an obvious low, that low may become the draw. This is not a promise. It is a way to describe the most obvious target. After liquidity is taken, watch delivery. Delivery means the quality of the move after the liquidity event. Does price move away with strength? Does it create displacement? Does it break nearby structure? Or does it drift and return to the same level? Liquidity by itself is incomplete. The movement after liquidity tells you whether the event mattered. Premium and discount can be kept simple. Take a visible range from a swing low to a swing high. The upper half is premium, the lower half is discount. In a bullish idea, traders may prefer to see price react from discount before reaching buy-side liquidity. In a bearish idea, traders may prefer to see price react from premium before reaching sell-side liquidity. For beginners, keep this as context, not a rule. In a trend, liquidity can help explain pullbacks and continuation. An uptrend may take sell-side liquidity below an internal pullback low, then continue toward external buy-side liquidity. A downtrend may take buy-side liquidity above an internal pullback high, then continue toward external sell-side liquidity. This connects directly to pullbacks. A pullback may collect internal liquidity before the trend continues. The larger structure still matters. In a range, liquidity often builds on both sides. The range high can hold buy-side liquidity. The range low can hold sell-side liquidity. Price may sweep one side and move back toward the other, or price may finally accept outside the range and begin a new leg. Do not treat every sweep as a reversal. Read the response after the level is taken. Liquidity also connects to reversals. A bearish reversal may begin after price takes buy-side liquidity above a high and then breaks structure lower. A bullish reversal may begin after price takes sell-side liquidity below a low and then breaks structure higher. The liquidity event is the setup area. The structure break is the evidence that keeps the analysis grounded. Do not make liquidity mystical. It is not a secret force. It is not a guarantee that price must visit a level. It is a practical way to mark visible areas where orders may rest. The strongest reads combine liquidity with market structure, supply and demand, candle behavior, and context. If liquidity language makes the chart more confusing, simplify it. A beginner workflow can stay simple. First, mark the major swing high and swing low. Second, mark obvious equal highs and equal lows. Third, separate external liquidity from internal liquidity. Fourth, watch what happens when price reaches a pool. Fifth, look for response and structure before forming a conclusion. The goal is a clean map, not a complicated forecast. The first mistake is marking every tiny high and low as important liquidity. The second mistake is assuming every liquidity pool must be taken. The third mistake is ignoring the response after liquidity is taken. The fourth mistake is using liquidity words to force a story that structure does not support. Good liquidity analysis should make the chart simpler. If it does not, reduce the number of levels. Here's the recap. Liquidity means areas where orders may be resting. Buy-side liquidity often sits above highs. Sell-side liquidity often sits below lows. External liquidity is outside the smaller move. Internal liquidity is inside the path. Equal highs and equal lows are visible pools. The response after liquidity is taken matters more than the label. ICT liquidity gives you language for where price may be reaching. But after price reaches liquidity, the next question is how it moves away. Does the move leave a clean imbalance? Does it create displacement? Does it leave an area price may revisit later? In the next chapter, we will study fair value gaps. That will help us understand imbalance, displacement, and why some fast moves leave important areas behind.